The first great thing about these companies is that their costs are fixed and they get all the upside for free. So typically these royalty and streaming companies are making an upfront investment, and they're doing this at a price in which they think they'll get a reasonable rate of return if the metal prices stay the same and the reserves don't grow. But over time, the metal prices tend to go up, and also the reserves of the mine tend to grow as the mining company invests more and more money in exploration, because it's in their best interest to make sure that mine runs as many years as possible. By the way, I'm Jordan from miningstockmonkey.com, and I'm coming at you from my home in Querétaro, Mexico. If you're going to invest in a gold or silver company, it's probably because you think the price of the metal is going to go up a lot. Well, in the last 5 years, the price of gold has gone up from about $1,300 an ounce to $2,000 an ounce. So a $700 increase in the gold price. And what have the gold miners done? Basically nothing. The average miner is pretty much flat over those 5 years in that period of huge increasing gold prices. So why? Well, let's take Barrick Gold, for example. So Barrick Gold is arguably one of the best gold miners in the world. It's the second biggest, and they have what are probably the best assets in the world. And 5 years ago, their all-in sustaining costs, what it cost them to produce an ounce of gold, was approximately $800 an ounce. Today, that number is about $1,300 an ounce. So the price of gold has gone up $700 an ounce over that period, but their costs have also gone up $500 an ounce. So that's why the stock price has gone nowhere. That combined with their output decreasing a bit as well. And what has happened to the royalty and streaming companies over that same 5-year period? Well, most of them have increased their production. Well, they don't actually produce anything, but increase the amount of ounces they're receiving. Plus, they're receiving an extra $700 an ounce approximately for every ounce of gold that they're getting. So their profits have gone up dramatically, while miners' profits have basically stayed flat despite the gold price going up like crazy. So while Barrick Gold's stock price has remained basically flat, the royalty and streaming companies have more or less doubled during that same time period. And that's doubling when we're in a really weak market right now. Like, sentiment is horrible and prices are greatly depressed. So you have doubles despite that happening. If you're enjoying this video, please subscribe to the channel. You can do so for free with the click of a button. Something else that's great about these companies is that they get all the exploration upside for free. For example, a royalty company might pay an upfront payment to get a royalty on a 2 million ounce gold deposit. Well, it's in that operator's best interest to grow that resource, to spend money drilling to try to find more and more ounces. So the company producing the gold spends tens of millions of dollars drilling out the deposit, trying to find as many ounces as possible, and converts that 2 million ounce deposit into a 4 million ounce deposit. Well, that resource doubled and the royalty company didn't have to spend a dime. They got all of it for free. And if you're new to this sector, you might be thinking, well, what are the odds of the resource size doubling? That must be pretty low, right? No, actually, that is very, very common. As you can probably tell, I love these royalty and streaming companies, but even though they have a great business model, you still need to conduct thorough research to assess their benefits and risks. And another reason that I want to own these companies is that something else that's common is road blockades and strikes that get the mines shut down. Let's say a mine gets shut down from a strike or a road blockade. Well, yeah, the royalty company doesn't get any ounces for a while because the mining company isn't producing any. However, the royalty company doesn't have any costs associated with that. Whereas the mining company still has to pay all their employees, they still have to operate a bunch of equipment, spend a bunch of money on energy. It is very expensive to keep a mine running, even if you aren't producing anything. Plus, you might have to spend money like dealing with the local community to make them happy, so the blockade is removed and the mine can reopen. The royalty company faces none of those costs, and those ounces just sit in the ground at no cost to them until they're ready to be mined again. Hey, by the way, could you do me a favor and click that like button if you're enjoying this video, because it helps out a lot. In mining jurisdictions all around the world, taxes and social rents on mining have been increasing like crazy, and it's something that's going up and up and up. And like when you're owning a producer, like a gold producer, it's really hard because these taxes and these social rents just keep increasing, and it's hard to make any more money even as the prices of the metals go up. Well, when you own a royalty or streaming company, well, these increased taxes and social rents usually don't apply to you. And depending on the jurisdiction, the royalty companies may even get a favorable tax treatment, resulting in a lower tax burden for the investors. Something else that's so great about these companies as an investment is they take so few people to run. They're such a simple business. Franco-Nevada, for example, the biggest royalty company out there, has 45 employees, and they have a market cap of over $30 billion. That's nearly $1 billion in market cap per employee, which might be a record. I don't know of any company that's better than that. And why do you need so few employees at these companies? Well, it's because it's such a great business model and they're so simple to run. Warren Buffett says that he likes to invest in companies that can be run by an idiot, because eventually an idiot will run it. But fortunately, in the whole sector, I don't think I could name a single company that isn't run by very smart people. When it comes to gold mining companies, like the companies that are actually producing the gold, you cannot own those through the bear market because you are going to lose your shirt. These companies lose so much money in the bear markets, so you absolutely cannot own them. However, the royalty and streaming companies are a lot better in that sense, because you still get a lot of leverage on the upside in the bull market, but then when it comes to the bear market, the stock prices of these royalty and streaming companies typically don't go down nearly as much. And a big plus is that these royalty companies are still making a ton of money in the bear market because their costs are so low. And also, since a lot of the mining companies get into trouble in the bear markets and these royalty and streaming companies have a ton of cash, they can typically pick up royalties and streams on world-class assets for pennies on the dollar, which makes for a great long-term investment. Another great thing about these companies is their diversification. The typical royalty and streaming company owns assets all around the world in many different jurisdictions in various stages of development and production, so it's hard to beat the diversification from your typical royalty or streaming company. Since these companies are so well diversified and they have relatively predictable cash flow, and also they have huge margins, well, they typically have a low cost of capital, so they can borrow money at great rates to acquire more and more assets. So if the interest rates are 5% on the 10-year treasury, a great company may be able to borrow at 7% or 8%. Well, these royalty and streaming companies can consistently deploy capital, getting 15% returns over time. So when you can do that, when you can borrow at 8% and get 15% on your money, well, that's a no-brainer and a great way to grow the business. There's a number of companies in the royalty and streaming space that I would be comfortable investing my money into and just going sailing around the world for 10 years. Like, seriously, these are such great companies run by great, honest people with a great business model. How many times can I say great? But yeah, because of this, because of all of these attributes, you don't have to watch it every day. You don't have to watch that stock price like crazy. You can just invest your money when it's a good value and then go golfing or fishing, and you can not even look at it for years and have a pretty good idea that your money is in safe hands and will be worth a lot more in the future. And because these are such great companies, you're just going to sleep better at night. They may not be super exciting, like giving you tenfold gains in just a few years, although they could if it's a good enough bull market, but you don't need that to become really wealthy. Like, if you invest in quality companies like this and you just let your money sit there for years and the earnings and dividends are compounding, well, you could become a very wealthy person over the years with relatively low risk. Now, of course, there's still risk. There's risks with everything in life, so the risks aren't zero, but I think that the benefits and the potential returns greatly outweigh the relatively low risk that you face. And speaking of risks, the royalty and streaming companies have limited exposure to environmental and regulatory risks that the miners face. Like, typically the royalty and streaming companies face much fewer risks from the governments than the miners do. And by the way, most of the things on this list don't just apply to the precious metal royalty companies. They also apply to the diversified royalty companies and also to the oil and gas royalty companies. By the way, after I share with you the final reason to own these royalty and streaming companies, I'm going to share with you one of my top picks, something I think is a great value right now and has a decade of huge growth to come. So stick around for that. The next reason to own these royalty and streaming companies is that when generalists, investors, and institutions come into this sector looking for great companies, they're going to be looking for the biggest and the best that are super liquid. So they're going to be looking for the companies with the highest margins, and when they start looking at the various options, what they're going to come to is the biggest and best royalty and streaming companies. So that's one great reason to own them, because they're going to be some of the most certain to move in a bull market, but they'll also probably be the first to move. And it's also worth noting that these companies get very overbought and really oversold. Just make sure you're getting in at a good price and you're doing your due diligence.